This is my 25x stock that I've been covering on this channel for over a year now, and it just tanked nearly 30% in 2 days. But in the past year, even after this drop, they're outperforming stocks like Tesla. So, is this a buying opportunity? Why the heck did it drop? What am I doing with my position? And how did I prepare for this? All in this video. Let's do it. My name is Matthew, and today we're talking all things Celsius, ticker CELH. I've been covering this stock on this channel since it was roughly $22 per share about a year ago on this channel, and since then I provided pretty consistent coverage as well. So in this installment, we'll cover the earnings highlights from the most recent quarter, we'll figure out why it dropped and it's not what you think, and finally, if I was buying or selling leading into earnings, and if I'm buying or selling now. If we start by taking a look at their headlines, it looks to have been an incredible quarter for revenue growth, but a miss on profitability. Sales jumped an amazing 157%, driven by 214% growth domestically. However, due to shipping and logistics issues, international growth did stall temporarily for this quarter. Now, not only is 157% a staggering number alone, but there's a bigger reason why this is so important. For a hyper-growth company, especially one at such a high valuation, they need revenue growth acceleration. See, this is high revenue growth. 50%, 50%, 50%, that's great. But a hyper-growth company is one with revenue growth acceleration, where revenue growth itself is increasing sequentially. So you have 50%, 70%, 100% growth year over year, and this is what demands a premium, and it's exactly what Celsius is delivering. And I'll show you with their actual numbers. Boom, Q1 of this year, 78% year over year growth. Q2 of this year, 117% year over year growth, and Q3, their most recent earnings, 157% growth. So before we dive into why the stock dropped and the issues with profitability, first the question of, what is making revenue jump so quickly? Well, they've seen triple-digit growth in traditional channels, massive SKU expansion with existing partners, 429% growth in their DSD network distributor revenues, 38,000 new stores additions since the start of this year, led by convenience store expansion, and triple-digit growth in fitness and vending channels. A better way to illustrate all that is this graph right here, which shows how quickly Celsius is gaining dollar market share. Look at this absolute explosion. And they're kicking things into higher gear with massive displays and, of course, Celsius coolers. They've placed 900 coolers so far in 2021, with 400 of those being placed in Q3 alone, showing serious acceleration on that front as well. And I am lucky enough to have one just a few minutes away from my apartment, so I can get some juicy intel for all of you. Now, finally, their market share on Amazon, which everyone loves to talk about, is now 18.4%, making them the second largest energy drink on Amazon, 2.88% ahead of Red Bull and just 7.6% behind Monster Energy. So if this is also great, why did the stock drop? 1, the earnings miss, of course. 2, margin compression, meaning margins getting smaller. And 3, an SEC subpoena. So let's settle the first 2 reasons for the drop. They absolutely stunned on revenue, but they missed EPS and their margins fell. I put some numbers together and we can see that starting from the bottom line, we see a sharp drop in net income and an ultra thin profit margin when you look year over year. And now we have to ask ourselves, was this caused by mismanagement or external factors like aluminum can shortages, inflation, freight costs, and supply chain issues? Well, management says that their normalized gross margin would have been 47.2% if you subtract the short-term rise in spot prices of aluminum, their international cans being held up at ports, and increased fuel and freight costs, among other things. All of these are under cost of goods sold and therefore reduce gross margin. Now, we always want to trust but verify when listening to management. One way to verify is to build something like this where we can actually see what caused that drop in net income. First, did this affect the whole industry? I would say yes. If we compare Celsius to Monster Energy and their most recent report, we see Monster also saw an increase in cost of goods sold, decrease in gross margin, and decrease in net profit margin. The next important thing is that sales and marketing as a percentage of revenue stayed nearly flat for Celsius, and total operating expenses, which includes sales and marketing, also stayed flat as a percentage of revenue. This is huge because 1, it tells us that sales and marketing grew proportionately to sales growth. You don't want to see S&M as a percentage of revenue increasing dramatically because that means management is spending more on marketing for every dollar of revenue, and that's very inefficient. And 2, this tells us that OPEX, or operating expenses, also stayed proportional. In other words, these 2 things were not what caused their net income margin to drop so significantly. But now we see operating margin was down huge huge as well despite operating expenses staying proportional. So what gives? This means that gross margin must have been the reason for the decline in net income margin. And what impacts gross margin? External factors like aluminum can shortages, inflation, freight costs, and supply chain issues. It's starting to look like management is definitely telling the truth. And sure enough, we see COGS, or cost of goods sold, as a percentage of revenue has increased, thus decreasing Celsius's gross margins. And the final thing I'll do to verify that margins are indeed being mainly impacted by short-term external forces and not management incompetence is create a pro forma financials with the normalized gross margin that Celsius gave us. In other words, and in simpler terms, they told us that in normal conditions, they would have seen a gross margin of 47.2%. So if I plug that in, and that's the only thing I change, all the other expenses stay the same, roughly, look what happens to the bottom line. Suddenly, we're in the same range as a year ago in terms of net income margin. So in conclusion, and in order to build our conviction, we can say that yes, with a degree of certainty, the drop in profit margin was caused by short-term external factors and not mismanagement or a fundamental shift in the business. So there you go. We just squashed the earnings miss concern. And we have some bigger news too, because don't be surprised if next year at this same time, gross margins are in the 50% range. The reason why I think so is the CEO, John Fieldly, essentially said, we slowed down our promotions and velocity in sales didn't decrease one bit. You know what that means? That means Celsius is reaching scale, organic growth. The growth of their market share is no longer directly proportional to the amount they spend on marketing. They're also continuing to invest heavily in distribution so that in the long run, things become more efficient and margins can improve. And moving forward into 2022, their cost per aluminum can will likely be materially reduced as they source more of them from within the US. However, they use the FIFO accounting method for recognizing cost of goods sold. So this means that these cost savings might not show up until later in 2022. So yeah, in my opinion, management is absolutely killing it in terms of managing margins and costs in this tough environment for the beverage industry. I'll also add that their balance sheet is still looking strong. You'll notice a huge jump in inventory, which is Celsius arming themselves against supply chain woes, and I love that. And even if we subtract inventory from current assets, their quick ratio is still above 1, which tells me they're solid for at least the next 12 months, and in general, they hold little to no debt relative to their cash position, which I love. So now we get on to the third reason for the drop, and that is an SEC subpoena. On November 11th, Celsius reported earnings and the stock opened up big and then came down throughout the day, but it still closed at $97 per share. The market reaction was all in all pretty neutral for earnings. However, the next day, November 12th, when their 10Q filing was accepted by the SEC and probably showed up on their website, that is when we saw the massive red candle that brought us down 14% in one day. The theory for the delayed reaction? Well, inside that 10Q was a section called Commitments and Contingencies, which highlights things that the company may have an obligation to. In this case, one item was a class action lawsuit against Celsius, claiming that their use of citric acid while claiming no preservatives was against California laws. So I checked around my network and asked as many lawyers as I could get my hands on, and most of them said that this was pretty toothless. It was not going to be a major concern. The worst case scenario is probably a small fine, slap on the wrist, and relabeling of their cans. Yet for some reason, this story is what most investors seem to latch onto, when in reality, the second part of their commitments and contingencies was more concerning. The second paragraph says the SEC issued a subpoena on August 20th, 2021 for the production of documents in connection with a non-public fact-finding inquiry. There is nothing conclusive, but lawyer friends said this could range from insider trading to major securities laws violations, which could, in the absolute worst case, impact their ability to remain listed. But I don't want to cause panic because we literally have no idea what's going on and nothing has been brought to light yet. It's just an unknown for now. So at the moment, for me, this is not a reason to sell. But if the bears want to use this to give me shares at a better price, well, I'm okay with that. And that's a perfect segue into our final part of the video. Is this stock now a buy? What I'm doing and how I prepared for this. First, I want to share why I was trimming my position and reducing my position size as we were going into earnings. And this is something I did mention publicly in several YouTube videos leading up to their earnings report. Also keep in mind that Celsius does remain one of my top 2 largest positions in my portfolio, so it's not like I've lost conviction. It's still one of my highest conviction plays. The reason I was trimming heading into earnings was because of shocker, valuation. I don't care who you are, if you're trading at 40 times revenue as a beverage company with razor thin margins and a lot of headwinds for your industry, and you're heading into earnings, you better come out with an insane beat, you better raise guidance, and you better announce that you're going into the EV sector or something. And if you don't do all of that, then your shares are probably going down after your next earnings report. And that's why I reduced my position by about 50 shares from 250 to 200. And of course, all those trades were broadcast real time to all the members of the investor community. You can check that out in the link below if you'd like. So now, where am I thinking of adding again? And is it a buy? Well, guess where we're going to start? The valuation, my main reason for trimming in the first place. If you watch this channel, you know I like to use next 12 months enterprise value to revenues as a metric for valuing growth companies because it allows us to look at the next 12 months, which is important for a high growth company. It takes into account debt and cash by looking at enterprise value instead of market cap. And of course, we're looking at the top line, we're looking at revenue when it comes to growth stocks. If we look at this chart, which is not the stock price of Celsius, but actually its next 12 months EV to revenue multiple being tracked throughout time, by this metric, this is the cheapest Celsius has been since almost exactly a year ago in November 2020. So in terms of valuation, it peaked in February at over 30 times next 12 months EV to revenues and slowly downtrended since then in terms of this multiple. But if you look at the stock price of Celsius, it actually looks something like this. It uptrended for most of the year. So why is this next 12 months EV to revenue decreasing while the stock price is rising? That's because estimates for Celsius's next 12 months revenues kept increasing. So if its enterprise value divided by next 12 months revenues and higher projections increase the size of next 12 months revenues, you have a larger denominator, meaning a smaller multiple. Anyways, all you need to know is that Celsius is cheaper right now than at any point in the past year based on this metric, despite the stock being higher. That's a good start for context. And it also proves to any new investors that valuation and expensiveness is a lot more than just the share price. Now we compare it to its peers. So here's a comps table I made with Celsius, Monster Energy, Tattooed Chef, and Guru, another energy drink. Celsius and Guru are trading in the highest in terms of next 12 months EV to revenue, but Celsius is by far the highest growth throughout 2021 and by far the highest expected growth for 2022. Guru has the greatest gross profit margin, but none of it reaches the bottom line, and Celsius is right in the middle of the pack with its gross margin of nearly 40%, and it's one of two that is profitable. You can feel free to pause this, but I'd say this makes Celsius look somewhat fairly valued. I think at any price, plus or minus 10% from where it is today, should be a good deal. And when I say good deal here, I don't mean it's a screaming buy, undervalued as heck. It's more like this is maybe a good spot to start dipping your toes. All right, so now let's see if we can use a bit of TA to help us find a good entry. And again, not my expertise, more the expertise of our technical analysis mentor, Kevin, who does this for his literal living. But I would say, $74 to $75 range could be a potential turning point for this stock on this drop, but I want to see confirmation first. Stocks, when they're dropping this quickly, are always guilty until they prove themselves to be innocent. I think I stole that quote from Kevin, so credit to him for that one. Now, if I see no confirmation, it just keeps dropping, I'll wait for it to maybe test the $70 range as it approaches the 200 SMA. Anywhere in this range, I'd be potentially interested in doing a bit of nibbling. Now, this part's important. If you don't have a position yet in this stock, if I were in your shoes, not financial advice, if I were in your shoes though, I probably would not be buying a huge position at this level because I think it's still risky based on my risk tolerance. If you have more risk tolerance than I do, then by all means, do whatever you'd like to do. But if I had no shares in Celsius and I want to make it a 10-15% position in my portfolio, I would need it to drop a lot more before I fill out that entire position. But if you're looking for more of a risky play or speculative play of maybe 2 to 3% of your portfolio, this could be a place to start a position in Celsius. For me personally, I don't see myself adding any more than 30 to 50 shares in this range here because I already have 200 shares and my initial position was maximum of 250, so I probably don't want to go any further than that unless I end up adding a bunch of cash to my portfolio and I'm able to reduce the position size of Celsius. This is like the range for itchy fingers who don't want to take a risk of waiting for it to dip further. That's what I would call this. If I do make any trades, of course, all members of the investor community will know in real time, so you can check that out in the description below. And while you're down there, also definitely check out the Hungry Bull financial news app without the BS. I hope you guys enjoyed and subscribe.